Okay, let's read over this case in Chapter 4 regarding professional ethics. So we want to read the situation and then state whether it's a violation of the code. And then if it is a violation, why do we think it's a violation? So we have that Jessica has been serving as the senior auditor on the audit of Carolina BioHealth. Because of her outstanding work, the head of the internal audit at Carolina BioHealth extended her an offer of employment to join the internal audit department as an audit manager. When discussions with Caroline began, Jessica informed her office managing partner and was removed from the audit engagement. So was this a violation? So then no, it is not. I mean, many times these auditors do get jobs from their audit clients. So the key to this one is that as soon as the discussions began, she notified her manager. So she was very honest, forthcoming, said what was happening. And then because at that point her independence would have been questionable, they pulled her off the engagement. Had she stayed on, that could have been a violation, but in this case, she was honest and got pulled off. Okay, then B, we have the audit firm of Miller and Yancey CPAs has joined an association of other CPA firms across the country to enhance the types of professional services the firm can provide. Miller and Yancey share resources with these other firms in the association, including audit methodologies, audit manuals, and common IT systems for billing and time recording. One of the partners in Miller Yancey has a direct financial interest in the audit client of another firm in that association. Is that a violation? So no. So again, we allow these professional companies to come together and share resources many times because they're not that big and they can't do everything on their own. So just because they're in an association with other CPAs and they're sharing knowledge and IT and things like that, that does not limit their independence then. So because a whole other person in that association has a client, doesn't impact them at all. So that's a no. Okay, then we have Spencer Dunn is a partner in charge of the audit at Brentwood Bank. Dunn is in the process of purchasing a mountain house and has obtained mortgage financing through Brentwood Bank. So the key to this one is in the process of. So it's just going on right now. So he hasn't actually secured the mortgage. I mean, he got pre-approved from them, but it's all still in the works. So then that means he does have a personal interest in that bank. So his independence would be impaired. If it was pre-existing, if like 2 years ago he had that mortgage from Brentwood Bank and then got placed on the audit, then there's nothing current happening. So that key to that one is in the process of. But that would be a violation of his independence. Okay, then we have Melanie Greer's audit client has a material investment in Summit Inc. Greer's non-dependent parents also own shares in Summit, and Summit is not a test client of Greer's firm. The amount of the parents' ownership in Summit is not significant to Greer's net worth. So no, because her parents are not dependent on her, they're not like living in her household, and it's not significant to her net worth, her independence is not violated. Okay, then we have Joe is a former partner of Pinnacle and Hughes CPAs. Recently, he left the firm to become a chief operating officer of Ensworth Closing, which is an audit client of Pinnacle and Hughes. In his new role, Pugh has no responsibilities for financial reporting, and Pinnacle and Hughes have made significant changes to the audit plan for the upcoming audit. So then that too would be a no. His independence would not be impaired and there'd be no violation of any code. We talked in the chapter that if he had a role in the finance or the financial reporting, he'd have to take a year off, but he does not. So in his new role, he has no responsibility for financial reporting, so he doesn't have to worry about that year off. He can move right into that company, and then there'd be no violation of any of the rules. Okay, then we have O'Donnell Incorporated has struggled financially and has been unable to pay their audit fee to the auditors, Seal and Seal, for 2017 and 2018 audits. Seal and Seal is currently planning the 2019 audit. So they are 2 years past due. They have not collected these audit fees, and now they're working on year 3. So that would be a violation. I mean, one, you wouldn't even think they'd want to do it, right? The client hasn't paid you for 2 years. Why would you want to go into year 3 with them? But what it says in the policies is that you can have 1 year past due and not considered any type of violation. But to go beyond 1 year, that would be a violation. Okay, then G. Morris and Williams, a regional CPA firm, is providing information systems consulting to one of their publicly traded clients, audit clients, and they are assisting in the implementation of new financial reporting systems selected by management. So yes, that is a violation. It's a publicly traded audit client, so they cannot provide information systems consulting, nor could they help them set up their financial reporting system. So that would definitely be a violation of auditing standards. They need to stay completely independent. All right, then our last one, Chris Lancaster is a financial analyst in the financial reporting department of Cockerham International, which is a privately held firm, so they're not publicly traded. Chris was asked to prepare several journal entries for Cockerham International related to transactions that had not yet occurred. The entries are reflected in their financial statements that the company recently provided to the bank in connection with loans outstanding due to that bank. So no, that is not allowed. That actually sounds extremely questionable. So even though they're not privately held, the client is asking him to make some journal entries to correct the financial statements that they've already provided to the bank. So that would he kind of knowingly is doing that, like almost I can't say it's fraudulent, but it almost seems like it could be. So he's knowingly making these entries after the fact, which would be a violation of auditing standards. Okay, so I thought that one was a good one because sometimes it's nice to read through real scenarios and say, okay, does that seem good or bad? So hopefully that helps.